Good afternoon, everybody, and welcome to the FET Profits Macro webinar for this week. Patrick Ganley here with Angus Geddes. Angus, how are you today?
Yeah, good. Thanks, Patrick.
Good. So we're going to start off with the presentation. We've got a lot to get through today. Just some housekeeping items, disclaimer, presentation with the FET Profits website and content is provided for general advice only. Before acting on any of the ideas or recommendations or investment objectives, please consult a financial advisor before doing so. And remember, past performance is no indication of future gains or performance. Comments and questions during the presentation, you'll be able to answer, comment, or type in some questions. You got the orange arrow here where you can type them in. We'll endeavor to get through all the questions as we get through the presentation and the content today. If you can't hear the presenter or the presentation, please give us a call at the office, 1-300-88-1177, and someone in the office will try to help you so that we can get you hearing the presentation a little bit better. So FET Profits market update. We'll get started into the presentation today. Angus, I thought we'd start with the US 10-year bond yield, and this is quite an interesting chart that we have here. So I know you got quite a few comments on this today.
Yeah, look, we've seen the big technical breach of that sort of 4.35% level on the 10-year, and it sort of ran away to the top side. I've got to apologise to our listeners today. I've actually got a pretty bad cold, but nevertheless, let's just try and get through today's webinar. So we've had a breach of this technical level. The US 10-year bonds bond yield has sort of run away to the top side. We saw the 2-year hit 5%. The 10-year went through 4.6, and what we've sort of been seeing really, I guess, in the last probably over the last week since we've had these topside breakouts in the yield is an increasing sensitivity from some of those major US benchmarks. And of particular note, we've seen quite an adverse reaction in some of those semiconductor stocks, some of the growth stocks. The Nasdaq's been leading on the downside. And in fact, we've sort of seen probably the worst performance from tech really since back in January. So I guess the bottom line is that what we're seeing is stocks are no longer, or certain sectors are no longer to remain totally agnostic to the fact that yield pressures coming through from the bond market, which is pressuring valuations. We've also seen the small cap, mid cap Russell 2000 break some technical levels. Of course, small mid cap companies are a lot more sensitive to rising interest rates. And so we can talk a little bit about that later on. But all in all, I think the first comment I'll make is this breakout in the 10-year bond yield, which points to further upside in those bond yields. And, that's pressuring the stock market. We also saw a decent rebound and a bounce and a breakout in the dollar index, which you would expect on a rise in bond yields. I made the point in one of my notes, I think it was last week, that I'm actually quite surprised the dollar index is not higher near term given where bond yields are. But I think that sort of points to, deteriorating fundamentals and a deteriorating fiscal position for the US government. What was also notable this week was really the continuation rally in those precious metals. It's the first time in many, many decades that we've seen the gold price actually make new record highs, which it did this week above 2,400 an ounce, despite the fact that the US dollar has been going up. Normally that would be a big headwind. So those are probably the big key takeaways, I think, from the action this week in the markets.
Okay, so if we talk about the US 2-year bond yield, we can see this is looking quite interesting as well. And where do you see this going, Angus? Do you think this is going to go higher, or do you think it's going to come off here?
Well, I certainly think it's going to test the that top side level. which is about 5.1%. I think we're going to see that, and potentially also on the 10-year. A lot is going to come down to upcoming inflation prints and where the narrative moves around the Fed potentially easing later this year. If there's more pushback on that mid-year sort of rate cut narrative, which there has been, I think markets are now pricing in a 46% probability of the first rate cut starting in July. If we see any further pushback, it's going to impact the short end of the curve. And, I think the technical setup for the US 2-year bond is bearish. In other words, I think the yield is going to go higher. So, if we're looking for catalysts for a correction in the US market, I think, this is really it. And of course, we're also in the middle of reporting season. The bar is stretched quite high, particularly for those mega cap tech stocks and AI related names. And I think, that's where the risks lie in a correction, which I think the US market is now in.
Okay, so that delves us straight into the S&P 500, where you're saying if you think if the bond yields are going to continue to go higher, it may look for a correction in the market. And this is quite an interesting chart, which kind of points into what you've been saying here.
Yeah, I think the correction started. I think we've seen the reaction from that record high on the S&P 500 above 5250. It's broken the uptrend that's been in place since the October-November lows. It's also breached the 50-day moving average. So the first line of defense for the S&P 500 is that big support level at 4,800, and then there's an even more formidable one at 4,600, which also coincides with the 200-day moving average. So both of those levels would be reasonable targets, I think, for the US correction. If it continues to play out over coming months. And that would be quite healthy in the overall scheme of things, given the magnitude of the rally with those US indices. A correction of 10% should not be sort of too unexpected. It's fairly typical. Does that mean the US goes back into a bear market? No, I think the US is in a bull market, and it's got further to go. But near term, I think, the direction's down. We also know that there's quite a lot of cash and liquidity on the sidelines. There's certainly a lot of people that missed the big rally that will look to buy, particularly some of those AI technology names. So, I think the 4,600 level will be vigorously defended. And I think there'll be a reasonable fight at the 4,800 level if we see the index trade down to those levels in coming weeks.
Will you see that as a pretty good buying opportunity if we get down to that level?
Well, for certain sectors, yes. For other sectors, no. I think, I won't be buying NVIDIA, for example. I won't be buying some of those overvalued, overinflated AI names, even though I'm a believer in AI. I just think those sectors of the market have got ahead of themselves. Regular readers of my note will know that I think there's a big rotation going on at the moment. I think we're in the early stage of that. And, I'm sort of focusing more on commodities and inflation hedges and companies with upgrade earnings potential, which I'm finding in abundance in the resources sector. So that'll be probably where I'll be focusing on.
Okay, so again, we've seen the Russell 2000 here, and that seems to be correcting as well. Is that correlated with the bond yields going up, or is there something else going on here?
No, I think they're directly correlated with the bond yields. Small mid-cap stocks are a lot more sensitive to rate hikes. Given, they're not these big, large sort of multinational mega cap tech companies with, billions of cash on the balance sheet. So they're a lot more sensitive and they tend to get knocked around. I think the most important point to really comment about this chart is the breakout that we saw a few weeks ago, and which many people and commentators and strategists pointed to as widening breadth. We're sort of seeing that reverse now. The breadth is actually going backwards, and we're seeing small mid-cap stocks really underperform quite badly in the US. So I think that's just something to be wary of, particularly amongst some of those technology names. We did have some, a relatively small position in some US small mid caps, which we have cut about a month ago. So I wouldn't be chasing the Russell 2000. And I think there's a good chance that we could see the index touch that 200-day moving average, which is lower at around that 1900 level.
Okay, so we'll move on to the semiconductor index, the SOX. That seems to be heading down as well. Is that consistent with your view that the bond yields are going to continue to go up?
Yeah, I think they're finally reacting to that. We saw one of the semiconductor manufacturing companies last night, ASML. They missed their earnings. They came off 7%. NVIDIA was down 4%. And we can see the SOX index breaking its uptrend since December. I mean, it has had a huge move, 3,100 to 5,200. I mean, that's a move of 60 to 70%. This sector has really contributed a lot to the outperformance of the S&P 500 and the NASDAQ. And now that it's breached the 50-day moving average, I think it's going to reset at 4,200 on the downside, and potentially even 3,900. So a decent retracement coming for the SOX, and that's going to be a sort of a headwind for the major benchmarks. And I got to emphasize, I wouldn't be rushing in to buy the semiconductors or the AI tech related names. I think they've had a huge run, and they're going through what will probably prove to be a decent rotation this year. Doesn't mean to say that the US indices can't go higher. I just think that the big thing that's going on is sector rotation, where investors are moving out of tech-related names and they're moving into materials, energy, commodities, those types of sectors, cyclicals, which are cheap, but which potentially have the potential to deliver decent upside earnings revisions and upgrades in the market.
Okay, and if we bring it back to Australia and we take a look at the ASX 200, you've got your chart up here of the action in the ASX 200. How do you think things are going to play out here in Australia?
I think the ASX 200 is going to hold up quite well. It spent a better part of 3 to 4 years building that big base, between at the bottom of the trend channel and that resistance level at 7,600. So I think support's going to be quite formidable there. We've got a tailwind from the Aussie dollar back below 65 cents. That's helping a lot of our materials companies in our resources sector and our commodities and our precious metals. And so if we do breach that 7,600, I don't think it's going to be too protracted. And I think there's going to be plenty of support coming through at the bottom of that trend channel, sort of around that 7.1, 7.2 mark.
Okay, so you've touched a little bit on about gold already. It's been a common theme that we've been talking about quite a bit in these sessions, and you're seeing quite a bit of value, and you've got a big focus in there on the commodities, especially gold. And we've seen quite a good movement up in the gold price here, as you can see on this chart.
Yeah, I think I wanted to put this chart up today because it's the first time I've seen a 20% up move in the gold price to new record highs when it took out that big historical resistance level at 2000, where the buying hasn't come from retail investors, it hasn't come from institutional investors. We can see, there's been quite significant outflows, excuse me, from those ETFs. It's really been the buying has really come from the central banks with deep pockets, and perhaps a few very large tactical hedge funds that have reweighted into the precious metals. So, excuse me, that is encouraging. That's encouraging because it just sort of says to me that a lot of people are not on this trade. They're underweight. A lot of global fund managers, a lot of institutional investors, retail investors are underweight precious metals. And of course, the sector's beginning to stand out now. It's got a lot of upgrade potential. The longer spot gold prices remain at these levels, the more the brokers are going to revise up their earnings forecasts. Many of the gold producers and the silver miners, a lot of them still screening feet. So, central bank buying has been pushing it. It's been systematic, and it's probably going to continue for some time. And I asked the question in my note this morning, what's sort of driving this? What's behind it? And I think, I think there are deep-seated fundamental macro reasons for why gold's running. And a lot of that goes back to some of these thematics that I've been discussing, Patrick, the de-dollarization, the desire by a lot of central banks to diversify their reserves away from the greenback. And whilst, we've seen the US dollar continue to rise, this is the first time in a long time I've seen the gold price move up strongly, with the US dollar rising in tandem as well, and bond yields as well, for that matter. So, this just sort of galvanizes me, and, I've sort of got conviction, despite the breakout in the dollar index, that the US dollar is going to enter a bear market sometime this year.
And I thought you had an interesting title to your note this morning, Angus, and an invidious decision looming here for the U.S. What was your thinking with all of that, as you came up with that headline today?
Well, I think they're in a difficult position. There's an election this year. You've got rampant fiscal spending, policies that were pursued by the Trump administration, but also the Biden administration. I don't see that turning around anytime soon. You've got US debt now rising at around $1 trillion a quarter. To put that in perspective, when George Bush took office in 2000, the national debt was at about 4. When Clinton took office in 92, it was at about 2. The US national debt's now at about 34, 35 trillion. It's rising $1 trillion every quarter. Bond yields continue to rise. It's going to put more pressure on that national debt, which is going to accelerate because of those ballooning interest rate costs. If they cut rates early, then they risk a resurgence of inflation. So I think the pressure is going to be on this year for the Federal Reserve to cut rates. I think they're going to be reluctant to do that. And meanwhile, we've got sort of upward pressure on inflation. So, I think this is providing a really good fundamental backdrop for the whole commodity complex, which now seems to be running. We saw coffee actually make new highs on supply shortages coming out of Brazil because of climate change. There's a range of commodities that are running. We've seen breakouts in copper. And of course, I think this is now being reflected in the precious metals. And to put the breakout of gold in perspective, I thought it was worth highlighting this chart. When gold formed a similar base between 2008, when it touched $1,000 an ounce, and 2010, when it broke out, it doubled. We saw similar moves back in the 70s. And so, whilst, there is a risk that gold could correct from 2,400, I think pullbacks are going to be quite shallow. I think there's plenty of deep pockets that are accumulating and buying. And, we could see higher levels in the gold price over the next few years. We've had a number of brokers have upgraded. Citibank's the latest, saying it could smash through 3,000. JP Morgan at 2,700. Goldman Sachs are at 2,800. So yeah, I think it's early days in the move, and rather than rushing out to buy the gold stocks when they're running hard, it always sort of pays to wait for those corrections and those sell-offs.
Okay.
If
And
we look at
sticking with one
silver,
of your core themes, obviously, gold's one of them that we've been talking about, that commodity. Now we're looking at silver. I know you've been talking quite a bit about silver and the setup here with the silver price and where you think things could head from here. And I know you think there's quite a bit of opportunity in silver in general.
yeah, I think silver has inflected to the top side. That big multi-year consolidation now looks complete. It's run straight up to the resistance level at those 5-year highs. Look, there might be some backing and filling and some consolidation with silver, but I don't think it's going, back down into that sort of $22, $24 range anytime soon. And ultimately, I think silver is cheap relative to gold. Demand is rising. It's used in solar panels. 25% of global silver demand is used now in solar. So I think a topside breakout is coming and new record highs above 30. But it's impossible to predict when that's going to happen. I suspect that could happen a little bit later in the year, particularly if we were to see the US dollar turn lower. But again, silver has managed to hit $30 when the dollar has risen and strengthened, and when those bond yields have risen. So that's all encouraging signs. I think the big point to make about silver, we can just go back to that chart, is it has underperformed relative to gold, and historically, is screening cheap relative to gold. So we can expect some catch up.
Okay, thanks for that. And then now if we move on to some of the other commodities and things that we've been talking about, we got copper here, and copper seems to be breaking out too. And I know you got a positive view on the copper price.
Yeah, I'm very happy with copper and the way it's behaved technically in the last couple of weeks. It's managed to sustain that breakout above 380. It's touched 440, and it's just consolidating nicely, and it's moving to the top side. So I think that it's really only a matter of time before we see it push up to test that 480 high. In coming months, maybe the next few quarters, certainly the next few months. We know that there's fundamental shortages of copper. The copper stocks have all broken out and are looking technically quite robust. BHP and Rio are trading well. A big chunk of their revenue and EBITDA comes from copper, about 30%. So, I think better days lie ahead. And of course, this whole AI boom, a lot of people are chasing the expensive AI stocks, some of them with not much padding behind their valuation. And they're overlooking some of the base metals that are going to be needed, in these chips to build out the infrastructure. And of course, the power requirements. The world's going to need a lot more power in the next 10 years. So I think the base metals are in a sweet spot. I think copper is leading out of the base metals, but I think, we're going to see nickel and zinc and some of those other ones follow. So this is all good for the resources sector.
So with silver, I mean, one of the ways that I know you've been talking about, and one of the ways we've been suggesting that members can take advantage of investing in silver is through this Global X Silver Miners ETF, USSIL, and we've got the chart up here, and I know you think this looks quite good at the moment.
Yeah, I know we had a lot of inbound inquiry from our members thinking that they'd missed a rally. Well, I think this chart really puts it in perspective. I mean, the Global X Silver Miners ETF, which is listed in the US, which comprises a basket of 20 to 30 of the world's major silver miners. It's well down from its 2011 peak, near $100. It's trading at 31. I mean, its price action is encouraging. Recently it's pushed above the that downtrend, that dotted red line. I think it's only a matter of time now before SIL tests the primary downtrend, and a breakout above that level would confirm an important inflection. And we probably need to see more upside in the silver price for it to do that. I just need to reiterate that, where gold's underowned completely, silver's almost non-existent, and in investor portfolios. That goes for a lot of fund managers. So this is one that I'm keen on. I'm quite bullish on, and I think that the technical setup is bullish, as are the fundamentals.
Okay, so if we move on, we've spoken about the gold price. We've spoken about the gold price moving higher. We've looked at the 20-year gold price chart, and you've spoken a little bit about where you think that could be heading, given de-dollarization and some fundamental other things going on. But a good way to play it, which is something that's been a stock that we've been focused on and members would be very familiar with, is Evolution Mining. And I know that it's got two engines, Angus, and I know you're quite focused on Evolution Mining, and you like the setup here, and you think that the stock could go higher.
Yeah, I think the technical setup's looking really, really positive. It's very close to confirming an important topside inflection, breaking through that $4 resistance level. It was a wild ride. I'd admit that. We watched it go from 410, 420. It went immediately back down and tested the bottom of the range at 280 when their production quarterly numbers missed, and a lot of people just gave up on it. But it's come roaring back. They had a good quarterly result out yesterday, which has led to a number of broker upgrades for Evolution. And I think 70% exposure to gold, 30% from copper. I think the copper acquisition where they bought Northparkes late last year, did a capital raising at sort of 420 to pay for that, was very well timed. And as you say, it's got two engines. It's got copper and it's got gold, and they are two commodities that we're really bullish on. So yeah, we might see some consolidation now around that $4 level before the stock's ready to push higher.
Okay, so we'll switch gears here a little bit, and thought we'd talk a little bit about the Hang Seng. And I know you and I have spoken about this quite a bit recently, and I think you're starting to see this to look pretty attractive.
Yeah, look, I continue to put this in front of our members, on the daily. I think that the technical setup is quite bullish for the CSI 300 and the Hang Seng. Those markets to me have bottomed. The Hang Seng's tested that bottom at 15,000 twice now. It put it in the fourth quarter of 22 and retested it in the first quarter of this year. It's held. Now, while the primary downtrend, which has been in place since the 2020 highs at 31,000, that has yet to be broken. So, we're yet to see that index confirm an inflection, but I think one's coming. It's on a forward PE multiple of about 6 times, which historically is as cheap as the market gets. We're also seeing some green shoots emerge in the Chinese economy, and we're spotting a lot of value over there at the moment, like companies with decent revenue growth and earnings power that are now doing quite well relative to the indexes. So that's where I'm sort of focusing on at the moment.
Okay, so Evolution, we spoke about. We're talking about the Hang Seng now, and we're going to move on to the CSI 300, and this looks quite interesting as well.
Yeah, so China upgraded the GDP numbers printed at 5.3% this week. That was quite a bit ahead of what the market was looking for. Retail sales were patchy, and that sort of took the luster off the GDP print, and the manufacturing numbers were down. But I do think that the economy is beginning to muddle through this economic downturn, which says to me that the CSI 300 has also bottomed. I mean, the stock market is a forward-looking discounting machine. It's not looking at where the economy is today. It's looking at where the economy is going to be in 12 months' time. And I think those cumulative sort of fiscal stimulus measures being deployed over there are beginning to pay off. The CSI 300 is very close. Can we just put that chart up, please? The CSI 300 is very close to breaking that primary downtrend. So now's the time to be looking for some of those sort of China, Hong Kong names, which have decent earnings growth profiles.
And I know there's a couple stocks that we wanted to talk about as we relate to China. And one of the stocks we've spoken about a couple times now is Wynn Macau, listed in Hong Kong, 1128. And here's the chart of Wynn Macau.
I think that looks really good. We've seen since the breakout from that primary downtrend and the 50 and 200-day moving averages, Wynn Macau's comfortably held above all of those levels. We saw an initial move from $6.90 to $8. It's now back at $7.30. It's testing the breakout level, which I think will hold. That's one stock that we've certainly been focused on, and looks good at the moment.
Okay, and another stock that we thought we'd put in front of members today, MGM China, listed in Hong Kong, 2282, and looks like this stock has started to break out as well, Angus.
Yeah, so it's really exited a bear market that's been in place since 2014, albeit with plenty of sort of highs and lows along the way. But I think that primary downtrend's significant. It's pushed out above that. The scope is now raised for significant upside, I think, in MGM China. MGM China, like Wynn Macau, screens cheap out of all those gaming companies. There's also the potential there for upside earnings revisions. We're seeing the gross gaming revenue numbers coming through. They're almost back at pre-pandemic levels, whereas, the stocks are, many of these stocks are sort of well down from where they were trading. So yeah, I think the recovery potential is good.
Okay, and if we come back home, we've spoken a little bit about, or not a little bit, but we spoke a lot about commodities, resources. Here we've got a chart of BHP. How do you see BHP performing here?
Well, BHP and Rio should be, in everyone's portfolios, I think. BHP technically touched a new high at 50. It's come back. It's tested that big primary uptrend that's been in place since the 2016 lows. And all things being equal, I think there's a good probability that it will hold. It reported their numbers this morning. They were pretty good. I think iron ore prices are bottoming out and are going to soon reassert on the top side. I'll cover that off tomorrow. I think the copper price is also good, and 30% of BHP's earnings come from copper. So a couple of decent tailwinds there. All things being equal, I think, BHP research to the top side and retests those record highs over the coming year.
Okay, so now we'll get into a few questions. Got a couple questions about how to place silver on the ASX, and do you have any comments on that, Angus?
It's a tricky one in Australia because there are no pure listed silver miners. There's no listed ETF which covers the silver miners. So you have to go to the US for that. South 32 is worth mentioning. They've got decent exposure to silver and also copper and the base metals. So I think that stock screens cheap. That's one way of playing it. We hold South 32 in our SMA portfolios. Yeah, so that's probably the only or the best way of playing it in Australia. I should
Another
also
question. If for some reason the central banks stop buying gold, do you think that's going to happen? And if it were to happen, and what do you think it's going to do to the gold price?
Put it another way. The central banks that are buying gold are actually also selling US dollars. And no, I don't think that trend is going to change anytime soon. We can talk about the gold price till the cows come home at record levels, but the flip side of the equation, the other side of the coin, is that what these central banks are doing are moving out of US dollars. So I think that is a trend that's going to continue. I think it's not just US dollars, it's US bonds, and potentially even equities as other markets screen cheap and the US market screens expensive. The US has been the only game in town really in terms of the stock market for the last 12 months. But we're seeing a lot of value emerge in Europe, the UK, Australia, and the likes of Japan and China, Hong Kong. So look, I don't think the central banks are going to slow down. I think it's being driven by geopolitical tensions where countries are now quite rightly concerned that if they get on the wrong side of the US, they'll get hit with sanctions and they'll have assets frozen. So precious metals are off the grid. There's nothing the US government can do to go after gold that's in your vault if that vault is on domestic soil. So I think that's real. Bonds haven't been a great place to park reserve assets. Bonds are in a secular bear market, and we talked about that in the presentation. I think the secular bear market on bonds is going to go for some time, and increasingly, fiscal position of governments. They're spending beyond their means. They're borrowing too much. What does that mean for the long run? Does it mean a lot of money printing? I think so. So I think these big, deep pockets that are behind this move in gold. We discussed that it's not the retail investor, retail flows, which have been instrumental and influential in the past. It's these big, deep pockets. So, the world is awash in US dollars. So it's really about the diversification away from the greenback. And I think it's not so much the buying of gold; it's more the selling of dollars that's the real trend here. And whilst we've seen the US dollar index move up and touch 106 this week, I do not think that signifies a new bull market for the dollar. I'm just waiting for the cracks in the dam to appear, and for the greenback to start sort of rolling over later this year.
Okay, and just a quick overview, and if you could just give us your thoughts here on the Japanese stock market at the moment, and what you're seeing going on in Japan.
Look, Japan's had a big run to the top side. It has had a big run to the top side. All things being equal, Japan's going to have a correction as well. Probably in the vicinity of 5 to 10%. I'd say it'll be in line with the US. I see probably a less prominent correction with the ASX 200 and the FTSE 100. I think the pullbacks there will be more mild. But yeah, look, near term, Japanese stocks could come off. They're in a situation where you've got the yen, which has hit 154.5, 155 this week. I mean, the Bank of Japan and the finance ministry are going to have to do something. The world kind of knows that jawboning is not going to work, and even FX intervention might work for a few days or a few weeks. but it's probably not going to last for that long, and that's where the Japanese government essentially intervenes and starts buying yen. So I think stronger measures are going to be needed, and I think that'll bring forward their rate tightening policy. I think we're going to see some rate hikes come through sooner rather than later. And it's really worth emphasizing that, there's a massive, massive short position in the yen globally. It's very, very lopsided. Whenever I've seen a market this skewed in one direction, there's a reaction coming the other way. So, so look, Japan could correct some of those exporters, which we don't have much exposure to. We have very, very little exposure to. It's those exporting names, the car manufacturers, they could all get knocked around if the yen were to strengthen. But I think, for financial stocks, a rise in the yen would be more than offset by a rise in domestic interest rates, where their net interest margins would expand. So that's kind of where we're focused on. But I wouldn't be buying Japanese stocks today. I'd be waiting for a bit of a shakeout. That bull market is alive and well. I think it's a secular bull market that follows a 30-year secular bear market. And there's a lot further to go on the upside. We haven't heard the end of the Japanese story by any means.
Okay, well, I think that covers most of what we wanted to get done today. I'd like to thank all the members that have been able to join us today for the presentation. We hope you've got some value out of that. If you have any questions about any of the content today, please give us a call, 1-300-88-1177, or you can email us at members@fatprofits.com.au. Also, if you have any questions or any interest in what we're doing in wealth management and our managed accounts, please give us a call, and we'll look to be able to provide you some information on how we're doing in the wealth management business. Angus, thank you for today. I know you've been a bit under the weather. I had it last week. It's not great, but I think we got through the presentation today, and hope you feel better soon. Thank you, everybody, and we'll say bye for now.
Sorry about the scratchy voice.